Good morning and welcome to a new investment summit by Fan Society. Today I'm delighted to introduce an investment theme that is very dear to me, as I am a total supporter of sustainable development. ESG investing is key to sustainable development. Investors may choose to avoid companies that are bad for the environment, companies that follow unethical practices, or those who are harmful for society. In this way, they help to achieve sustainable development goals. But now we know that introducing ESG factors in the construction of a portfolio is actually good for returns in the long term. And that is what we're going to talk about today, the case for ESG, generating alpha with a positive impact. And to do so, we have two wonderful sponsors that have been involved in sustainability for over 2 decades, Pictet and Schroders. But before we move any further, I would like to remind you that we will have a Q&A session after the panel. To introduce questions, you can do it at any time during the panel using the Q&A feature you have at the bottom of your screens. Also, if you prefer, you can send us an email with the questions to info@fansociety.com. Pictet Asset Management launched its first ESG best-in-class fund at the end of the 1990s. But maybe you know them better for being the pioneers in thematic investment. Pictet Asset Management launched the first water fund in the industry in the year 2000, making it the seed for its whole suite of environmental funds. We can learn more about Pictet's sustainability efforts through this video.
In less than 30 years' time, our planet will be home to 9 billion people, many of them forming a new urban middle class. And as more people move to cities, they consume more food, water and energy than their rural counterparts. The impact on the environment is increasingly apparent. Many governments and businesses are promoting sustainability and responding to consumer concerns. And here lies the opportunity for long-term investors.
Awareness of environmental issues continues to grow among consumers and within the private sector. Think about the ban on diesel cars in Europe, plastic pollution in the oceans, water shortages in India, just to name a few topics that we read about in the newspapers. We believe this growing awareness is driving a strong demand for solutions.
To help with investment decisions, we use a scientific framework called planetary boundaries. This defines a safe operating space for humanity. We can assess if companies are working safely or if they are potentially harming the environment.
There's 9 dimensions that are really important for the planet. Climate change is one of them, it's very important, but there's also the biodiversity one, the freshwater cycle one, the nitrogen cycle one, chemical pollution, and others.
Planetary boundaries has allowed us to narrow down an opportunity set of around 3,500 companies to an investment universe of about 400 companies. We call our strategy Global Environmental Opportunities, or GEO.
By using this framework, we're able to identify solution providers that remain safely within these boundaries across a wide range of industries, from simulation software to plant-based alternatives to meat. Overall, GEO has a strong focus on environmental technology and innovation.
We believe it's the fusion of sustainability and innovation that offers potential for exceptional gains. Cleaner energy can reduce a company's carbon footprint, cut production costs, and alter consumers' spending habits. Consumers increasingly demand smart design, provided by companies that combine strong environmental credentials with innovative products and services.
In summary, at Pictet Asset Management, we believe that focusing on the environment is a smart way to invest in global equities, and that financial performance and a positive environmental impact can go hand in hand.
Pictet Asset Management, pioneers in thematic equity investments.
Schroders has a sustainability team that was established 22 years ago, which is dedicated to identifying long-term structural trends and leading engagement with the companies they invest in. We can learn more about the research team at Schroders through the following video.
Companies don't operate in a vacuum. They're affected by society and have impacts on society. Understanding that relationship, which is the focus of our sustainability research, has never been more important, with companies' role in society under growing scrutiny. For most of the last 70 years, companies were able to operate by pushing a lot of the costs created by their products, services, and operations back onto society. Effective tax rates, workers' share of GDP, regulatory compliance costs, fines, all fell for many decades, going back to at least the mid-20th century. Governments had to pick up a lot of the strain. Twice as many employed workers need welfare payments to make ends meet as was the case a decade ago. The UN's warned climate action can't wait, and government budgets have been stretched to the limit. We're seeing a response and a rebalancing. Since the financial crisis, voters have given governments a stronger mandate to regulate irresponsible corporate behaviour. Companies are being forced to internalise costs they previously pushed onto society through minimum wage increases, tax clampdowns, carbon prices, sugar taxes, and a range of other regulations. More and more of companies' unpriced social impacts will become priced financial costs. That process has started, but has a lot further to run. As it does, some industries will come under intense pressure, and new winners and losers will emerge across the market. SustainX is the tool we have developed to quantify those impacts in economic terms through rigorous, extensive, and detailed analysis to help us identify future winners and losers. It asks the question, if companies were handed a bill for the costs they impose or the benefits they create, how large would that credit or debit be? We start by finding as many ways as possible in which companies can affect different stakeholders in society through the products they sell or the way they operate. Activities like paying wages, providing basic utility services, or developing new drugs have social benefits that are not listed on financial statements. On the other hand, carbon emissions, alcohol sales, or corruption all create unpriced social costs. Nearly all companies have a mix of positive and negative effects. At this point, we've identified around 50 impacts like those. The challenge is to quantify those impacts in economic terms, making them dollar values for individual companies rather than conceptual ideas. We've analysed over 500 academic studies looking at the costs of activities like carbon emissions, alcoholism, water services, or medical innovation to create a baseline. We translate those costs to individual companies using the best data we can find, some from company reports, some from other data providers, and some from more creative use of online and other sources. All of that work gives us a measure of social impact in hard dollar terms, which we can use to gauge social impact and the risks to future profitability. We have that analysis for around 9,000 companies, giving us a unique view of risks to companies and investments in the future. The implications are profound. Companies face a very different future to the past that lies behind them. Competition, profits, and growth rates will be reshaped as costs are redistributed. In total, around half of companies' earnings are at risk from the increase in costs they may face. But there are also huge variations. The tobacco, steel, and aerospace industries are anchored at the bottom of the table and face huge disruption risks going forward. On the other hand, telecom and healthcare industries are relatively well placed. They bring people access to information and develop the life-saving solutions that should insulate them from some of the pressures ahead. The world is changing. Companies face new pressures and new opportunities. Changes in the social contract between business and society are driving a lot of that change, and it's critical that investors prepare. SustainX helps our analysts, fund managers, and clients measure and manage the risks companies and investments face as social impacts become financial costs. It helps us prepare as well as we can for the risks that will emerge in the future, not just those that are already here.
So, hosting this event with Pictet Asset Management and Schroders is a privilege, but it gets even more interesting considering the first-class moderator we have for you today. It is Richard Zimmerman, Senior Advisor at We Family Offices, based in New York, where he leads the firm's values-aligned investing advisory service. Richard is a recognized speaker in the impact investing arena and works with some of the world's wealthiest families, helping them align their values to their investments. He has spoken at over 25 conferences, including the United Nations Sustainable Investing Conference. Richard has a Master of Science in Sustainability Management from Columbia University and a Bachelor in Arts from the University of Virginia. Welcome, Richard. The floor is yours.
Hi, Alicia. Thank you so much. And hello, everybody. As Alicia said, my name is Richard Zimmerman, and I'm a senior advisor at We Family Offices based in Miami, New York. Although you can see I'm operating from my home office. I'm really pleased to be your host for this conference on ESG investing. And a special thank you to the Fund Society and Pictet and Schroders and to all of you who are attending today. So in the next hour, we're going to go over the spectrum of ESG investing from the whats and the whys to the hows. To level to set our discussion, we're going to speak about ESG, environmental, social, and governance, as it mostly relates to public investing. Although we may touch upon impact investing as well, depending on where we go in the dialogue, and impact investing as it applies to the private markets. Let's go to our panelists. I'm going to introduce them, and we'll get into the discussion. As Alicia said, if you want to send a chat question, please do so. We can either have that question answered during the dialogue, or we're going to set time at the end. And I'm going to have the panelists introduce themselves. Luciano Diana, Senior Investor Manager at Thematic Equities at Pictet first. And Luciano, please introduce yourself and your role, and let us know what makes you excited about ESG investing.
Yes, thank you, Richard. So my role is a portfolio manager for the Global Environmental Opportunities Fund since inception in 2014. Before that, I used to manage a clean energy fund. What makes me excited? Well, first of all, I'm a thematic investor. So a part of my role is, in fact, to define an investment universe. We are benchmark agnostic, so we need really to look for the opportunities. And that's very exciting part of my job. In particular, then, I'm very passionate about the environment, about nature, and to be able to invest in companies that offer solutions for environmental degradation and pollution control, it really gives me a sense of purpose. So makes me feel good when I go to sleep at night.
Great, thank you. And now to Sarah Bratton Hughes, Head of Sustainability North America at Schroders.
Great, thank you, Richard. Happy to be here today. I am Head of Sustainability for North America here at Schroders. I lead our sustainability initiatives and strategy, as well as product development and integration efforts with our investors here on the ground in New York. I am so excited to work in this space. I think it's a space where we're seeing a significant amount of innovation, but not only just the innovation, but the capital that we're going to see continue to flow in the space. If you look at what we would need in terms of capital investment to reach the Paris Accord, it's $120 trillion by 2050 to meet our ambitious climate targets. And it's not just about climate. I also really enjoy the social part of it, and knowing that it's going to take private capital to solve some of these pressing problems that we have in the world, whether it's inequality, whether it's the pandemic that we're all dealing with now. So it's a really exciting and innovative space to be in.
Great, Sarah. Thank you so much. And I just want to add that I'm very passionate about this space, have been for many years. And what I'm seeing is this increased demand. We'll talk about that. So I want to learn about what your thoughts are on that. But this idea also that we can both improve returns and the society and planet. So I hope we touch on those topics as well. Let's go to the first set of questions. And this has to do with more overview and education. We have a lot of people on the call who have different knowledge base on this. So we're going to do kind of 101 first, and then it's kind of the what's and the why, and then we'll move into the how, as I said. So Luciano and Sarah, as an overview, can you both please describe ESG investing as you see it in your firms, and then move into, and we can talk about the demands and trends you're seeing in the space, especially in this COVID world. Let's start with Luciano.
Sure. So, well, first of all, the 101 is that ESG is a set of factors that goes beyond the conventional financial analysis. And it helps to capture everything that is material about a company that an investor should know about. And so in this perspective, it's a lens through which to look at the company and investment, and it's not an asset class in itself, in our opinion. The value add is that it's a complementary perspective on an investment, and it can be a differentiating point as well, because some of the ESG analysis still these days is a bit more qualitative than pure financial analysis, and therefore managers that spend more time than others can really differentiate themselves. Then ultimately, ESG in itself is only part of a broader concept of responsible investing and responsible capitalism. So integrating ESG in investment process in different ways can be strict integration, can be exclusion of certain sectors, it can be best-in-class approach. Maybe we can talk about these a bit more in the next few minutes, but that is only one part of the picture. Being a responsible investor also means practicing active ownership through proxy voting, through engagement, and also having a transparent reporting and communication. I think you mentioned about demand. For sure, we have seen a very strong demand in the last few quarters. I'd say really we saw a big inflection in the fourth quarter of last year. And what is interesting is that this demand hasn't really stopped with COVID. So this is about really investors that recognize the fact that there has been positive performance and they want to participate in this trend. But we can talk about that a bit later.
Okay, thanks. Yeah, I really liked how you mentioned that this is a lens. So let's say it wasn't ESG. We'll come back on this, but that it was just some other way of looking at the financials of a company, like many factors. So in essence, it's just extra information that's important. And then moving also into the thematic, the solve, and in terms of the idea of having responsible investing. Sarah, what are your thoughts on this?
Yes, I completely agree. And I always find it's always challenging to go second on the panel and provide a more differentiated point of view. But if we just take a step back and look at the entire spectrum of sustainable investing, you go everywhere from financial benefits really to philanthropy. And it sits along that spectrum. And how I would think about it was, if you had a series of circles along those spectrum, you would have integrated, which is to us here at Schroders just a better way of investing. And we've committed to having 100% of our assets integrated by the end of 2020. Then you move over to a sustainable approach. Then you can move over and do an exclusionary screened approach. And then when you move over one other bucket, really taking that impact approach. And then finally, at the end, you can approach it from a philanthropy perspective. So there is a long spectrum of it, of sustainable investing. Another way I like to think about it in simple terms is the A, B's, and C's, right? So A, avoidance, that's negative screening and an exclusionary approach. B, benefit, that's integration. So you're benefiting from integrating these long-term structural trends systematically into your investment process. And C, contributing, and that's where the dial is really moving to the thematic solutions. In terms of demand, I definitely double down on the point that it is continuing to increase, and it's increasing from all pockets globally. And I think part of that is because the conversation, both starting in 4Q last year and through the COVID crisis, has moved from values to value creation. We've moved beyond the performance myths that have been out there about sustainable investing, and I know we'll dig into those a little bit more. But we're seeing that, continuing to see that broad-based demand across the spectrum, many of it within that B, the benefits, so that integrated approach, the C, the contribution, so looking at thematic strategies that will benefit from it, and C, within the impact space. And so we're continuing to see that, and we're also seeing the investor base that cares about sustainable investing growing. So we do a global investor survey every year here at Schroders, and it's always the women and the millennials that want to put their money to work for sustainable investing. But last year was the first year that it was Gen X leading the charge. My own personal theory about that is because I akin 2019 to sort of the year of the Greta, and 2020, the year of COVID. So swinging that pendulum from the climate to the social issues. But I think a lot of people have younger relatives in their families that were really taking a part in that climate protest and wanted to understand how they could leave the world a better place.
Great, thank you. Yeah, I love the ABC. I hadn't heard that. It's a really good way to describe it and kind of the history of it, because the avoidance was really the beginning of it, especially in the 80s, 90s, and the exclusionary approach. Now the integration and then into the solutions. So I think that's an excellent way to look at it, and a way we can all kind of frame it up, because it's going to, you could enter in any of those areas, as you mentioned, or do them all. Just staying on this point for a second, Lisani, you talked about thematic. What do you mean by thematic investing?
Thematic investing is really an approach where, in a way, the investment universe gets restricted. So it always we start from the broadest possible opportunity set, but then we want to look for companies that are exposed to mega trends that are shaping society. And the first thing that we do is we identify where the mega trends intersect. So technology development, demographic developments, healthcare. And then we identify subsets of the global equity markets where we can invest. And we have the belief that these companies will outperform the global equity markets because they're exposed to secular growth. So at the core of thematic investing is the search for secular growth dynamics.
Thematic then, because we've had megatrend investing for years in different categories, and now it seems like it's falling into this ESG impact world. So is climate change a mega trend, and are the issues around the social issues, the diversity issues also mega trends?
Thematic funds since, in fact, the water, which was one of the first ones that we launched 20 years ago. And among these, we've had 5 linked to the environment. So water, clean energy, timber, and then the global environmental that I'm managing right now. And so some of these themes, yes, are mega trends linked to the environment. And we see, for example, the resource efficiency and the pollution control being 2 important ones that underpin our investment philosophy.
Okay, great. Sarah, do you want to touch upon that as well as your approach to thematics? And then later on in a couple more minutes, we can get into, I just want to go a little bit deeper on the demand side that you both raised.
Yes, so here at Schroders, we have a global transformation range. And many of those themes that underpin that align with the Sustainable Development Goals, as we're seeing more people want to align their investments to the SDGs, Sustainable Development Goals. So really searching for themes that are going to benefit from the capital moving in that direction. So we've launched Schroders Global Sustainable Growth, which at its heart is searching for the most sustainable business models that are going to tend to benefit over time. We have a global healthcare fund, climate change fund, a energy transition fund that is supposed to benefit from this 120 trillion. We'll see an investment into renewable energy by 2050 if we want to meet the targets. And we've also have a global disruption fund because, you know, at its heart, as people try to find solutions to these pressing sustainability problems, there's going to be a lot of disruption in the market as well.
What's amazing is over the last probably 5 or 10 years, and very much the last couple of years, firms such as Pictet, Schroders, the sophistication has just, the technology, the amount of capital that you put into this, all different kinds of capital, knowledge capital, as well as financial capital, is amazing in what you're coming up with. And so the advisory community to take note of this, because there's real expertise in the field. On the demand side, do you feel that the COVID was something that would, in essence, caused this to become more of a forefront, or was this wave already occurring? And also, was COVID more directed towards just social issues? And does the environmental take a back seat, or is environmental also coming along in this? Sarah.
I think the wave was already happening prior to COVID, without a doubt. The wave had already started. It was moving beyond Europe's borders. We've had demand globally for more sustainable solutions. So it definitely had already happened. And you are also, and it seems a little odd saying that here in the US, sitting in the US, but you also have a favorable regulatory backdrop as well that's pushing capital into more sustainable solutions in most countries across the globe, not necessarily here in my home country. And I think the key thing too is people got beyond this. It's not exclusionary approach. It's not the same sustainable investing as the 90s. This is all about integrating ESG factors, these non-financial factors, that will result in better long-term risk-adjusted returns for our clients. And you hit on the investment side, and it's definitely been something we've heavily invested here in Schroders. Not only do we have a team of over 20 just focused on these sustainability issues, we're global. I'm on the ground here in New York. We have individuals on the ground in Asia, because we truly believe that if we take into account these long-term trends into our, as a long-term investor into our processes, it will lead to better risk returns over time for our clients. And we're continuing to build. You saw the video earlier of Andy talking about sustainability, but we have over 10 proprietary investment tools, all with the aim of taking these structural trends and turning them into actionable investment implications. And how do you do that? You have to take out what is intangible and turn it into the language that investors speak. So instead of talking in carbon footprint, which I've never heard a PM talk in my life, well, I should say there's one or two, we will look at something like, and we've created a carbon value at risk model. So it was saying, what would happen to this company's profitability if carbon was taxed at $100 a ton? So it's about taking what was intangible and turning it into the language that investors speak, which is data and dollars.
You know, and that's real interesting because, for instance, we'll have a family that may have a certain idea or value or concern or look for an opportunity, and you think that that's more thematic. So let's say it's climate. And then all of a sudden you can look across the entire portfolio and say, wait, this is an idea for investing in a smart way too, for something that's occurring. So you want to be ready for that. Let's get more on demand and your view of that among individual investors or institutional investors, if that's your space. And also just this whole idea that Sarah touched upon, but I think there was this feeling that before that you'd give up return for some reason, or you might even increase risk by going into the space. And I don't think any of the statistics now back that up, but what are your thoughts on that?
Yes, so on the COVID front, first of all, I think what was interesting is that we've had lockdowns of different economies. We still have them in certain parts of the world. And as a result, we had a really massive decline in emissions, the fastest on record. We realize that that is obviously not a sustainable way to reduce emissions. So we only have one choice, which is to focus on technology solutions. And that's what we've always said since the beginning. So there has to be a bit of a change in our behavior, but ultimately, if we want to fix the climate issues that we have, we need to look for technology. So I think that was very clear from COVID. Also, another thing that we noticed is that investors and the audience, the public, has a better idea of the link between human health and environmental health. So the health debate and the climate debate are also kind of starting to overlap, which raises again the awareness, which is at the core of the demand that we're seeing for products. We've talked about this also for many years. And this rise in awareness, Sarah mentioned Greta, it's all part of the public being more informed and wanting to do something. COVID is also accelerating technology transformations. This also links in a way to technology solutions that in. It's accelerating digitization, it's accelerating the need for renewable energy, for more sustainable transport solutions. And that plays to also the performance in the stock market of some of these investments that we make. So on the giving up returns trade-off, historically, for sure, that has been in investors' minds. What we see today is that, well, first of all, we have some, at least on the environmental side, that's the side that I understand and I know better, we have some funds that are more diversified compared to the past. So environmental funds 10 years ago were very narrow, maybe concentrated on renewable energy stocks, which were very volatile. They also needed a lot of government subsidies, so the performance often wasn't really positive, and so that created a negative investor experience. Now the definition of what's an environmental technology is broader, so the volatility of the products that are offered right now is also lower, and we've got the performance. So it really attracts many more investors than before. And then finally, we've had the last drawdown in February and March, where we've seen that many of the sustainable environmental funds perform better than the market. And in the past, this wasn't very clear. There was this idea also that ESG and sustainability is something that only works when the markets are supportive, that it's a luxury that companies cannot afford if we enter into an economic crisis. That's not really the case. And so we've seen, in fact, that in this difficult economic period, investors are choosing companies that are well managed, that have solid balance sheets, and that's what tends to be in sustainable ESG environmental funds, is these type of companies. So this combination of factors, I think, is creating a good background.
Got it. Thank you. Yeah, great points. And I see Sarah shaking your head. I want to go on to the next topic, but when we're talking about the COVID period and everyone's, wow, how did these things perform? I know it's just a slice in time, but the genre has performed very well. Any thoughts on that?
Yeah, I think Luciano put it perfectly. Sustainability is no longer a bull market luxury, as some investors had thought it was. It really held its own and outperformed throughout the crisis. It was outperforming going into the crisis, and it outperformed through the crisis. And a lot of people have said to me, oh, that's just because of tech and biotech, but it's not. There have been studies that have done, if you looked on a sector neutral basis as well, the more sustainable companies outperformed within that crisis. And there's also been some interesting studies done out of the US by an organization called Just Capital. And the companies that treated their workers better were also the companies that had outperformed throughout the crisis as well.
Yeah, that's a good point, because we're in a period where people are taking note of all this. You can't hide from it. And so companies that are going to address it straight on and be more responsible, I think, are going to be rewarded in terms of having more investor support. Why don't we go to the next topic? And both you all have already talked about your process a bit, but it certainly uses this as an opportunity to expand a little bit more. But what we want to talk about is the investment process, examples, how Schroders and Pictet approach this and approach integrating ESG and investing, and get into given that with about 10-minute time period, maybe a case study or an example, so people can get an idea of in the real world of what this means. And we'll start with Sarah.
Great, thank you. So at Schroders, we operate here as a series of boutiques, but our sustainable investment team reports into our head of investment. And the one thing I always want to stress is that we are building the tools and the frameworks and then analyzing these long-term trends and provide that specialty sustainability analysis for our investors. But this is not an outsourced ESG function here. The people that are closest to it and investing in their companies are, at the end of the day, who own the ESG analysis on the underlying stock. So today I wanted to feature on one of our flagship funds, which is Schroders Global Sustainable Growth Strategy. And why I chose this one is because they have a unique view and they're really utilizing sustainability to generate long-term alpha. It's a concentrated global equity strategy, really focused on patient capital and the belief that sustainable companies will beat the fade. So the most sustainable companies will have that superior operational performance, and over the long term, they'll have strong compounding returns, lower volatility, which we all know is important, as well as a lower cost of capital. And they've developed a unique proprietary investment framework called the SQ framework, and it's looking across 4 separate pillars to understand the complex interactions that companies have with society. And these 20 questions, and we truly believe that you need to dig into these companies, and it's moving beyond just a tick box approach. It's looking for areas that are weak and most material to their business model. And it's using both conventional and non-conventional data. I know we're probably going to talk about that at some point, but it's moving beyond just using conventional data. And it's using unconventional data to help uncover gems. And I'm not going to go into the environmental. One of the greatest examples in the stock is not an environmental. It's much more focused on social perspective. And it's a company that we held for a really long time. It's called Faricom, where the corporate responsibility has really underpinned their long-term growth. They're a Kenyan telecom company, and they own M-Pesa. M-Pesa is one of the world's leading money platforms, and it's over 50% of Kenyan GDP. And why is Safaricom so special? They truly believe that they are an important part of Kenyan society and take into account all stakeholders when they're investing. So they have a big focus on their customers and providing that service to their customers. And it's so strong that it has led to increasing market share and adoption over time. They have strong employee satisfaction, so they're not dealing with turnover, which costs businesses, particularly in the service industry, a lot of money. And we also, as a female, I'll say it, they have 50% female employees as well. And they have over 150 products where they have over 150 projects where they're investing across broader society. This is all leading to market share gains. And some people will say, oh, well, that's costing the company money. Well, you can change your workers over the short term, but over the long term, you can't. That's going to lead to unsustainable turnover. That's going to cost you. You'll also risk losing customers because you won't have employees that are adequately trained to answer customers' problems. And I like to say this because what has been the outcome for shareholders in this company? They've had over a 30% EPS growth in the last 5 years. And if you look at their total return since their listing in 2008, they're up over 2,000%. So you can be a company that treats all your stakeholders fairly, and it will actually lead to greater market share and market share gains over time, and lead to a better bottom line.
Quick follow-up on that. When you talk about integrating the data, your approach, ESG investing into the investment process, do you do it in an integrated way within your firm, or is the ESG team side of over there and they give some information and the investment team may or may not look at it? I mean, what's the approach here? How integrated is it, and is that important?
It is extremely important to our firm, and it's from a top-down and bottom-up perspective. From a top-down perspective, our CEO, Peter Harrison, our group chief executive, firmly believes that this will lead to better long-term returns for our investors if we systematically incorporate sustainability in our investment process. And I think it is bottom-up as well, because we've developed these tools and frameworks to look at across stakeholders, and we've given the flexibility to our investors to place the materiality per stakeholder. So we've developed all of these tools. It's another lens, and it's turning it's another lens, and it's another edge for our investors. And I think the performance question is a good one, and it's also helped internally as well. So this Schroders Global Sustainable Growth Strategy is one of our top performing funds across all of Schroders. It is benchmarked against a mainstream benchmark. We do not believe you should give up performance for investing sustainably. It's one of the top funds in global equity peer groups. And it's not just that. Even internally here, all of our sustainable strategies over the 1 and 3 years have outperformed their closest mainstream peer on that investment desk over that same period. So I think the investors, we've got that great top down and then that bottom up tension, because they realize this is just a better way of investing. And like I said earlier, it's all about translating it into their language, which is data and dollars. So it is integrated, and our proprietary systems are integrated throughout their investment processes.
Great, thank you. Luciano, same question on your investment process, maybe a case study or example. And I was interested in the film when they discussed the planetary boundaries, which I think was a terrific way of looking at things as well. And I don't know if you integrate that way into the investment process, or if that's an overarching kind of theme, but I'd love to hear about that.
Yes, so going back to also the beginning of the discussion about what is ESG, there's always the two dimensions. One is minimizing risks, and the other one is maximizing the opportunities. And so when we look at an investment process framework, that good one has to address both. And in a way, the planetary boundaries looks at integrating ESG in a definition of the investment universe to exclude parts of the economy that we think are going to be structurally challenged going forward. And we think that they're not worth investing in. And it's a very, very important part of the process. And maybe I can spend just a minute to describe it. So it's a framework that, as I mentioned in the video, identifies these 9 environmental dimensions. For each one, there's a threshold, there's a boundary that is indicated by the scientific community. And if the system goes beyond this boundary, then we risk nonlinear change. So as investors, what we want to do is to look for companies that operate within these boundaries, and what's it called, the safe operating space. And in other words, these are companies that have a low environmental footprint. So we do believe that companies that don't overuse natural resources ultimately, over the long term, will have tailwinds. And the flip side of that is that companies that overuse natural resources will have all kinds of headwinds against them. And we are seeing the example with the traditional energy sector in terms of regulation on CO2. We see examples a bit all over the place about companies that don't respect the environment. So this is really the first part of the investment process, but it's a crucial part. Then the second part is about defining what is an opportunity. So having a very clear and scientific view of what is a solution that brings a net positive impact. And the net word is also important because there could be situations where a company has a great solution for one on the environmental dimensions, maybe the CO2 dimension, but would cause a lot of damage on the nitrogen cycle, on another dimension, on the water cycle. So we want to also use a lot of life cycle analysis, and that's a very also important framework that we use to calculate the level of emissions, environmental emissions, that are related to a certain economic activity from the cradle to the grave, alongside all the dimensions that are relevant. So by using these two tools, we have an approach that gives us a restricted investment universe. It's around 400 stocks that we use then to choose 50 or so stocks that go into the portfolio. So ours is a global equity portfolio. It's very concentrated. It has also as a reference index MSCI World All Country, because we believe that that's what our clients want. They want outperformance versus this reference index. And it's also constructed to have a volatility that is similar to that of the market. So the beta historically has been around 1. And in our case as well, this is a fund that has outperformed by over 4% per year the MSCI World or Country. So with a level of volatility that is similar. So it's a good risk reward, and it's increasingly used as a core equity allocation. So we are not in a situation of a core satellite situation, but this is truly a choice for a core equity product.
Okay, that's a good point, because I was interested in that, whether or not thematic kind of fit as a sliver, but not necessarily within a regular, throughout portfolio construction. So that's very interesting. To both of you, and by the way, to the audience, if you want to put up a question, please do. And I think we have a way to get it here. But both of you talked about benchmarks at the beginning, Luciano. I think you did. It might have been the film, but I think you said something about being benchmark agnostic. Sarah, you talked about it's important to mark these against the traditional benchmarks. So just a little bit more about benchmarking, but beyond that, what really means for success of this? Beyond just the financial, whether or not it's against a benchmark or there's a financial return, but what are your thoughts about success that might be more subjective or qualitative in nature? Oh, Sarah, why don't you go?
Okay.
Jump in.
Yes, it's something we are thinking about and investing heavily here at Schroders. So it's not just about saying you're investing sustainability anymore. It's also about showing it. And to us, it's no longer about a quarterly brochure about what our sustainable investment is doing, but it's actually looking at the fund level and understanding the impact that an investment is having on society from the fund level. So we have invested heavily in fund level sustainability reporting, not just for our global sustainable growth strategy, but across our entire platform here at Schroders. We really feel like this is the third dimension of performance reporting, if you think how it's evolved over time. So at first you had just performance, then you had risk factors added in, and now you're going to have those sustainability and the impact factors in, because all investments make an impact, and people are demanding now that it's not just about showing the financial returns, but what are the impacts by investment on society. And I also think that's why SustainX is a unique tool, because it quantifies those impacts across almost 50 factors that companies are having on society. And I go back to global sustainable growth because if you SustainX across that portfolio, you will see that versus its mainstream benchmark, that fund adds a positive over positive $5 to society for every $100 of sales, versus the benchmark, which is negative. So it costs society. Owning the market, it just costs society. So building these tools, the ability to quantify, the ability to report, the ability to measure is something that we are continuing to see. And I think that if you look at this strategy, you don't give up any performance at all. It's actually an alpha generator. to have a superior sustainability profile.
Oh, great, very interesting. Yeah, and just in our experience with families, when you move from just talking about, but talking about financial returns and the typical risk and return measures and how it affects their financial goals and financial life, and then you move into the idea of impact returns, the conversation completely changes and it gets very interesting, more colorful, more meaningful. So down the road, I see that statements will just have both in essence and be very customized. I think that's where we're headed in the industry. It's still early stage there. Luciano, on this topic, a little bit about benchmarking, but also about impact.
Richard, just a second.
Oh, yeah.
Hello, Richard.
Yep.
Yeah,
Hi,
I'm cutting in because we really have some questions, and maybe as we are already almost reaching the end, maybe we would like to push some questions through from the audience.
Perfect.
I can go through and maybe tell you a couple of questions we have. We have someone from the audience asking about what are your thoughts about ESG factors in emerging market players, specifically in Latin America? I don't know who would like to take this.
Who would like to take that one?
I'm not sure I'm the best person because we don't have Latin America exposure. So.
Okay.
Yeah, we don't approach it any different for our Latin American investment desks than we do. We still expect those desks to be 100% integrated. We've talked a lot about the E and the S today. We haven't talked about the G, which is crucially important, particularly as you're investing in emerging markets across the world. What we see is, from an investment perspective, is that we might have to approach it a little bit different. We're still using that broad stakeholder framework. However, the data availability in some of these emerging markets isn't like investing in European large cap. These companies are often smaller, often don't have the huge IR teams, but to us, these are where you can find some of the most sustainable business models in the world. I mean, the company I chose to highlight to you is the Kenyan telecom company that has continued to outperform over time. So we actually do think that governance crucially important, and I think the social piece is crucially important. You've seen it here with Safaricom gaining market share, providing a valuable business to society, treating their employees and their customers right. We, within our emerging markets debt fund, we used to have a holding that was a sewer company based in Latin America. And they did a lot of projects with the various communities, not only providing the sewering, but cleaning up the local rivers, which led to market share gains over time because they were providing that valuable service. So for us, it's just as important to integrate sustainability into emerging markets. It's just that data piece that sometimes isn't there, and it involves a little more engagement with those management teams.
Thank you. Well, and now we have another question that maybe even you, Richard, might be able to help us with. How would you recommend us to address a client who is approaching ESG investing for the first time? There are so many products in the market that it's difficult to focus. This is a question from one of our participants.
Yeah, I'm happy to touch upon that, and certainly our panelists can chime in. First, I think, is to get up to speed yourself if you're an advisor in the space. Learn as much as you can. Be open. This field is growing. There are a lot of experts there. So just increase your knowledge base yourself. Second is be open to that this is a combination of a discussion based upon values as well as investment opportunities in the traditional investment process. And I think, as Sarah said before, when she talked about the different generations, there are people coming at this from many different perspectives. So you'll have to understand that, because you have to be able to read your audience and get an idea of where are they coming at from this, what language did they listen to, what's going to be important to them. And so you'll have to have a number of different approaches. I would say Third, get excited yourself about it, and don't be shy. This is something where everybody's learning, so you don't have to be a complete expert, but I think if you're excited about it, you're open about it, and the families or clients or individuals that are working with you, or even the institutions, will as well. And then obviously you're experts and you'll know your products, you'll know how it fits into portfolios. I would say just to look at it the same way, so that you don't have to change your taxonomy or your framework or anything else. It approaches the same way. And if it's supposed to be non-concessionary or market return in that part of the portfolio or that part of the strategy, then follow that. There's some cases where there might be a concessionary return. That's what Sarah mentioned, that was closer to philanthropy, but in general, it just fit in the portfolio like other assets and other investments. Panelists?
Thank you very much, Richard.
Okay.
Maybe we have time for one last question regarding, I'm sorry, politics. Yeah, we have a question asking us about if the upcoming election in the United States, its result is going to make a real difference for sustainable investing, at least here in the United States. I don't know if maybe Luciano, you can touch on this just to close the panel.
Yeah, I can definitely touch on this. Well, the policy that is being proposed is quite different between the two candidates. Of course, if we have Mr. Biden elected, he's talking about a 2 trillion type of program to stimulate clean energy investments and also in a way to bring back environmental regulation and legislation that has been dismantled by the current administration. So whether we're going to have him or President Trump reelected, I think it will make a difference. It's fair to say, though, that we've had in the last 4 years a very positive dynamic of innovation in the environmental space, also in the United States, despite all the rollback in legislation. And so this is very important to keep in mind that the corporate sector, for example, is going into a certain direction, which is to comply, to be better corporate citizen, to invest more in sustainability, regardless of regulation. And so, yes, so I think the situation will be positive either way.
Thank you very much, Luciano. So I'm afraid we do not have time to have any more or take any more questions. I would like to thank every one of you, Richard, for leading this panel, Sarah and Luciano for your views and your ideas, and of course, Schroders and Pictet Asset Management for sponsoring the event, and We Family Offices for sharing Richard with us for the morning. And this is it. So thank you, everybody. Thank you very much. And I hope we can all invest sustainably in the future.
Thank you.
Thank you.
Thank you.